Hello, welcome. This is Danji Varasani from danvicharting.com, danvi-charting.com. Thank you for joining me. I wish to review options trade that we considered nearly 3 months ago on gold, in which I introduced a possible way of using an option. And then likewise, I also wish to go on to provide a follow-up on the last video I did on Nikkei Index and how we might be able to use options in order to perhaps consider possible trades. So before we get on to the content of the material, you can stop the video and read through the disclaimer, basically that I am not authorized by any government regulatory bodies in any jurisdictions to advise, but rather the material is presented in the form of educational material and informative material. But you will need to exercise your own due diligence and see whom else you might need to consult in order to ascertain whether anything that we discuss in this video is suitable for you or not. So you will be entirely responsible for your own action. Stop the video and read through the disclaimer. Having said that, first thing you need to take note of is the fact that I do have a basic website running under the name of danvi-charting.com, and this is the website. So the first thing I would ask you to do all is to go across to that website, and under the contact you can do a basic registration. This will enable you to receive any future free material that I might circulate, and also any additional services that I introduced, you will want to be updated on that. And in particular, we've been talking about options trading. So that is one service that is seriously being considered and possibly start from 1st of September. And in order for you to get enlisted or enrolled on that service, you need to really sign up during the month of September, and more details will be provided to you in the future communications. So the first thing to do is to go to the website and at least register your interest, and then you will be updated on that. So having said that, the original trade that we introduced was on gold. So you can see the particular chart that I published if you went across to tradingview.com, and this is the first homepage on tradingview.com. You will see I am listed there as Dan V, and if you click on that one, it will take you to my homepage and or my profile page rather, and this is where I published the chart 3 months ago, back in May, when the gold was in this consolidation triangle. And there is a video to go with that one in which I discussed the reasoning behind gold and why, what I was expecting here at the time. So in order for you to view that video, you can follow me on the YouTube channel, and this particular video here, which says basics of options, its use in trading and managing risk, that's the one which went into briefly speak about the options and various websites that you can visit in order to learn basics about options and how we might be able to use that when we were going to apply to the gold chart that we looked at here. And that's when the trade was actually planned, briefly explained on that video that I just mentioned. And what we did was kind of there were two possible options. One would have been a straightforward directional trade. That would have been the simplest possible trade you could have considered, or one where, because of the triangle, we weren't sure which way it was going to go, so we wanted to try and put ourselves in a position so that we could possibly benefit from a strong move in either direction. with eventually getting ourselves long once that correction was over. So to understand what that was all about, go and have a view that particular video, but I will show you on the chart what we did. And if you look at this particular screenshot, that's the one, as you can see, is on 27th of May, and these were the trades that we were looking at. So I will place these trades on the chart and go over with what we did, and then how things have transpired so far and what we are expecting. So briefly, just remember, and all these 4 trades, they were put as a bunch of trades together. It wasn't like one trade at a time, it was all placed as one trade, all 4 different combinations. And the total, there were 5 contracts, but you don't have to have 5, because if it's a relatively small account, you can only do just one of each. So instead of saying buy 5, it would read buy 1. And they were all December 2014 series, and I wanted to give it enough time so that the whole trade would complete by December. So that was the original plan. So it was the December series with these 4 different legs, and the total was $3.80 per each. So in other words, if you did just one contract will be of 100 shares in each of these legs, and the total would cost you $3.80. So for 100 it would cost you $380. So if you keep that in mind, $380, because you want to see that was the original amount invested and what would have happened and what has happened and what we are now looking to do. Okay, so that was the trade originally put on for $3.80. So I'll take you to the chart in which I placed that particular trade. So this is the chart, and on here you will see that each of those 4 trades we talked about, these 4 trades, they're put on a screen here. So for example, it says here December 2014, buy 1 put at, sell 1 put at 120. So this is the 120, so we sold that. And it also says sell 135 call. So this is the 135 call that we sold, and then we bought 125 put, 125 put, and we also bought 130 call. Okay, so I think 130 call here, and we bought 125 put. So I think this one here is my typing error. That should have been 125. Okay, so just to refresh, so here it is. So we sold 120 put, we sold that one, and likewise we sold 135 call, which is that one, and then we bought 125 put, which is this one here, and we also bought 130 call, which is that one there. So the reasoning behind it is that if the price of gold, and this vertical line is where the price was at the time, okay, we didn't know anything about here, but we expected that this could break to the downside, and originally we were expecting that if it broke to the downside it would have gone to our original target we were expecting, although this one then came down, but it didn't really travel far enough. We were expecting somewhere in the region of 1200 or 1220, didn't carry far enough, and it was disproportionate to the original leg here. So it didn't really get to the level that I was expecting, but instead we had an adverse excursion to the upside, and now we are back into some kind of a consolidation. So having said that, we bought these two, so if the prices went up, then we would benefit from our right to call, right to buy at 130, and if it went beyond this way, we would be covered by this 125 put option we bought. And the thing to remember is we didn't want to risk buying both of these and then find that the market spends a lot of time sideways. So we wanted to protect ourselves by selling these further away from the price, with a view that it would help us to cut down our overall cost of buying these two. So that was the reason why we made up these four. But if somebody wanted to place just a straightforward directional trade, they would have bought something like 125 put. That's it. So 125 put at the time, if you look at the screen, not that one. Oh, I think I closed that one. Another one. Okay, never mind. So 125, we would have just simply bought that one particular position, and we were expecting price to drop down to at least 120, and maybe it could have come down even further, but 120 is what we were looking for. So you would have had like a $50 potential move, and you would have obviously benefited from that. We hadn't actually gone there yet, but when we found that leg moved up there and now spending a lot of time here, then this one would have caused us a bit of puzzlement, and during the time that we are waiting, options are a wasting asset. So it doesn't help us if the price don't actually move in that direction quickly enough, because if we spend now nearly 3 months, so in that 3 months we haven't really gone anywhere other than where more or less where we were. So that would have been really disadvantageous to us, because we have lost 3 months worth of time. So this is why when you're looking at a position like this one, I personally preferred the combination legs, so where we are preparing to catch either side, but equally we are going to subsidize by selling these two far out options, with a view that it can subsidize us any time we lose in here, and of course enables us to catch either side rather than be wrong-footed. Okay, so that was the reason why. So we bought those for $3.80 on 27th of May. Then when the price came down, it actually came down to our strike level. So we could have really, even in that short time, we could have made good money. We could have exited, but I didn't, as I was expecting further decline. But then what happens is the price actually shot back to the other side. And interestingly, as you look at it, you can see that this is on a daily chart, but we have possibly 1, 2, 3, 4 and 5. So it's a 5-wave move up. So when I looked at that, I thought, if this is a 5-wave move up, is it a new move bullish to the upside, or is it something different? And of course, what came to me was that this leg, although it looks 5-wave impulsive, it probably is still part of the larger congestion, and in which case then I expected price to drop. Okay, so when I came to understand that, when the price were in this area, so you can see here, for example, on 24th of June, which is when I adjust the trade. This is the screenshot. So you can see on 24th of June is when I adjusted from the 4 legs that we had. I reversed my position on the 130 and 120, which were the 2 positions I sold. So here I reversed them. So 120 and 130. So to show you on the chart, 120 is that one there, and 130 is this one here. Okay, I wasn't actually planning to take this 130 off. My original intention when I did adjustment, we were here on 24th of June. Okay, so approximately on 24th of June. Okay, we were approximately there. So when we were there, I saw almost, it looks like 1, 2, 3, 4 and 5 that I showed was there. However, what we did have is that one actually wasn't a 5, it was a congestion wave 4, and we had then a final upthrust to complete the 5 wave. So when we had it here, I thought to myself, if this is a 5 wave, we should be at least expecting ABC retracement back, and that would confirm to me whether we are then going to go up higher, or whether this is going to be the end of the upthrust and we're going to now actually go for the down move that I was expecting to take place from this position. So with that reasoning, I took off this this buy call. Okay, so this one I bought. So here we weren't quite in a heavy money, but it was still positive, so I took that one off. But when I took that one off, accidentally, let's take a step back. This 120 put position that I sold, when we were over there, that had lost quite a bit of money. So what I did is I bought that one back, and that was my original plan, is to buy that one back. So if the position then turned back down, I don't have this one now costing me any more, because when the price went back to the other end, this one lost its value. So I sold it for something, it lost its value, so I bought it back with less money. Okay, but in process of doing that, accidentally I also took off my 130 call, and I was a bit puzzled by that. I don't know what I did, but it took that one off. So then when I realized, I said, okay, well, I can live with that, because ideally what happened then when the price was there is I took a little bit of money on this one and I took some money on that one. Now, having taken that off, if the price was to rally, then I would be in a danger of having this position, which is currently sold, to be naked. Potentially I wouldn't want price to go above that. If it went, I would have had to close it. Okay, but because we had the 5-way move up, I knew it can't go straight through or much higher. It has to at least do ABC retracement if this was a new leg. So I was looking for ABC retracement, and if I didn't have ABC retracement and I had something different, then I know that maybe this was the top. So anyway, when I was here, I reversed that. So what I did is I did the adjustment, as you see here. You see there, I closed the 120 put, and I also closed 130 call. Okay, so these were the prices that I got for them, right? So to show you in an equation, what I did the adjustment is I spent $3. Sorry, this is also a typo. It should have been $3.80. Okay, so originally we bought and sold as a complete trade for $3.80. Then subsequently, when I did the adjustment, I got back $3.40 and I had to pay $2.20. So I still left with $1.18 per each contract. So I had 5 contracts, remember? But if you were trading just one contract, then you would have collected $1.18 for closing this one and closing that one. Okay, so that is closing this position and closing this position. Okay, so closing those two, I would have gained $101.18. However, the overall I spent $3.80. So if you then take away the 118 from that, then you can see the net cost now is $2.62, with the understanding that if the price was to strengthen further up there, we would have to close out, so we would make a small loss. Okay, this $2.62 with the remaining position now cost us, we would have had to close that, and we would have had to close that maybe for like $2.70 or $2.80 or maybe even at $3. So you would have lost 40-50 cents, okay, per each share. So if you had one contract each, then that would be like 100 shares. so you would have lost $40 or $50, you know, maybe less, or maybe a little bit more, something in that order. However, now we know the price hasn't done ABC back, but it's actually doing something different. So when I saw that, I then reposted my chart, republished it, and you will find, show you that in a second, you'll find this is the chart. So when I saw, you can see when I published this one, that was published about just over a month ago. In fact, I'll show you on my so this was the original chart we were looking at for planning the trade, and then when we republished that chart, you can see this is the one here, this chart about a month ago. Okay, that's when I reviewed the entire price history from 2011 top, and explained to you in detail why I think now perhaps the original move I explained in the previous video, where this one I was labeling that as a 5 wave, okay, is now suspect. Maybe it wasn't a 5 wave, maybe this is simply like W, X and Y, okay. But not to get you too confused, I then republished that chart, and I'm now expecting the price to drop not only at 1200 but maybe go even below that. Maybe it might go up to 1100, maybe even 1050 or even 1000. So go back and check the notes that I have applied to explain why. But anyway, I'm expecting price to drop at least to 1200, a minimum. Okay, so what I have now is from the original trade that we planned, I've got this 1350 call which I sold out. So as the price drops, that one will start losing value now. But equally, I am still holding this put, 1250 put. So this 125 put will be gaining money. So really now I want price to drop in order for me to benefit in a maximum way. So this one will lose value, and hopefully it will lose fair enough that I will probably buy that one back for a very small cost. And this one put is going to gain me most money if it drops to like 1150 or lower, right? So now to take you onto the actual platform to show you the remaining position, what's going to happen is if I can find the remaining position. Okay, so in here, this is the remaining position on gold. So what I'm going to do is I'm going to go into okay, reload. Just bear with me a second. Okay, so what we're going to do is we're going to analyze the remaining position. Okay, and remember, this trade is still running up till December or close earlier if it meets a target. So don't get confused by all these lines, but basically from our previous thing here that we closed these two, so we've only got left now from this chart, we only got left now is we have sold this one and we still own the put. Okay, so we've sold that one out, we own the put. So what's going to happen now is on this trade analysis is currently gold is standing at approximately 1228. Okay, so that's where the vertical line is. Now if the gold gets to somewhere about 1200, which is what we're expecting or more, then you can see what the position will be worth approximately. Okay, so the one to look for is where it says, if I put my mouse here, okay, where it says current price. Look at the current price, right? So current price is if it drops down to somewhere about 11.18, then our position will be worth approximately $7.21. Okay, if for example we see as this one continues to go higher along the slope, what I mean to say, but it means price falling. So if it gets to somewhere about 1100, or better still say at 1150, okay, to be conservative, 1150 over here, so then the option will be worth nearly $9.97, so it's almost like $10. And if it gets even higher on the slope, that is, but the price actually drops of gold to say at $1,100, then you can see it will get to something somewhere in the region of about $14, right? $14. So at this moment in time, you know that our cost currently is only what it said on the chart here, is currently 260, but we might be able to sell that out for somewhere about $10, right? Collect it for $10. So what it means now is our position could be nearly 4 times bigger than current value here. So if you had one contract on that complex leg we entered, and now you close these other two that we're talking about, so you're only left with 100 of that, 100 of that, then you simply say, if you get currently, this would mean that is $260 cost. So if the gold falls to 1150, then we are looking at this value rising to somewhere about $10. So they're like 4 times. So that means it will be worth about $1,000. Okay. Now I know you might say, well, that's only $1,000. It took you nearly, 3 months already gone, and we don't know when it's going to get there. But the whole idea is that we were catching this congestion. So congestion often do actually become complex and do spend a lot of time. If you wanted to wait, you could have waited until all of that is clear, but then it suddenly could break, and you might be thinking, oh, do I enter now or not? So it basically you take your pick. So we entered like we did, and our objective was that whichever way gold goes, whilst in congestion, we want to try and see if we can make some money and then position ourselves for the real trade that was going to go long. Okay, from somewhere about 1200 at that time, but now from the recent analysis, I think we may actually drop well below 1200. We might actually make a new lower low. Okay, so if that happened, then we could be looking for this $260 turning into something like $1,000 or more, maybe like $1,200. And especially when it start falling fast, then the price of it would be really pumped up. So I wouldn't be surprised if it gets to like $1,200 or something. And that's a trade where you don't have to panic. You don't have to wait on the chart all day, waiting and monitoring and etc. Okay, so this was the gold trade. So now you got an update that currently we've closed this 2 position off, and we did that on 24th of June, and now we have a net cost of $262 per each, and we are now expecting for the price to drop down to at least to 12, but ideally make a new low around 1150 or maybe even lower, and we will see how that comes. And as the price drops, I think we should get a 5 wave up, as I've now indicated here, and we probably had a minor small wave 1, we've retraced wave 2, and now we are progression for wave 3. So if this one gets really strong, we should break out of this larger triangle and we should make a really strong move to the downside. If it doesn't, then we may spend a bit more time here before dropping down. So either way, we are expecting gold prices to fall quite sharply. If it doesn't, then we need to close this one. If the gold price start going back up then we'll need to close this position because we're not sure anymore what is happening to that. So what we will do then is that we would close the put position out, and we'll be just left with a call position. We'll take this one off as well, okay, because this one will start gaining money too, not as fast as our call, but we still start gaining money too. So if the price starts creeping back up above 1300, then we need to reconsider what's happening, review then, and if necessary, then we'd want to close this one off, and we may just leave the buy call. So if the price really begins to take off, maybe that was the final low, and in which case we've got 1300 call to make us some money to the upside, okay. But for the time being, I think it's the downside that we are going to be making money on. Sorry, my apologies, we've taken this one off, so that one doesn't exist anymore. So we'd have to buy this one back and reconsider whether we go long or not at that stage. So that's a price in gold. Let me know if you have any more questions, but you know, I understand maybe it's too much to take on all in a one go, but the whole idea is that if we didn't want to do this complex trade, we could have simply done a straightforward naked trade. And when you're talking about big swings, that's the kind of trade I would actually favor. But there are reasons why some combination sometimes also has an advantage. So that's a gold trade. We're still waiting for gold to drop and see if it actually does mature. Then we're looking to reap a good bit of profit on that one. So that's a gold done. Then a little while back, about a month ago, on the YouTube, you will see that I also published this particular video 2 weeks ago, in fact, under the heading of where to from here for the financial market, and that was done on 10th of August. Okay, now when we did that, I explained at length where I was coming from, but my focus of attention was Nikkei Index and how this might relate to Western indexes. Okay, so just to briefly recap that, but go into this video for much more greater detail behind my reasoning, because I won't spend a lot of time now covering the actual chart, simply to point them, because I'm now going to suggest a possible trade. Okay, so it all started from my eagerness to see exactly what had happened to Nikkei Index since it topped. And it appeared from my explanation that I gave in the previous video that this coming down was a clear 5 wave, then this congestion was a part of wave B, and now we should be having a wave C, which also must have 5 waves. And from my understanding, we may be looking for a 5 wave, and in which case we have what looks like to be some kind of a contracting triangle, where we have wave 1 and 2 and 3 already formed. Wave 4 was in progress when I took this particular screen capture on 23rd of August 2013. Using this, then I then developed my analysis here. As you can see, we had a contracting triangle, and well, wave 3 was complete. We were progressing in wave 4. We hadn't actually got to it where I was expecting, but I was expecting somewhere in the region of 16,500, where chances are that we would complete this retracement and start off a new leg to the downside. Okay, so we know what happened. For example, if we look at the Nikkei Index itself, we know subsequently that we did actually go and touch the 16,000 and just poke a little higher, but subsequently we have fallen. So my feeling is that we may well have topped, and also notable to me was that particular top was, as you can see, at the turn of the year. So 31st of December and 1st of January, that's basically when the top occurred. And in fact, that is exactly the same date when the Nikkei topped. It was also on 31st of December 1989 and 1st of January 1990. So it was turn of the year, and we already again have turn of the year. So that's significant, I think, although interesting if it was the coincidental. Nevertheless, we did expect a top, and we were going to expect this decline now. Okay, so in order for you to understand the reasoning, go and view that video and you will see. So looking at this chart, we're expecting either a zigzag down, if indeed these were a zigzag as I was expecting. Okay, so this was a zigzag down. Then I think we've also got another zigzag down, or we may have something that I haven't taken on board, maybe, but it looks unlikely that all of this is the way 1, 2, 3, 4 and 5 is feasible, but I think it's unlikely, because see, this cluster is right in the middle, and then we don't have a complete wave, 5 wave in that cycle. So I think it's more like a zigzag. So this would be like A, B and C, or W, X and Y. They're going up, come back down again, looks to me like a 3 wave down. So W, X and Y, and maybe we will have W, X and Y, or A, B and C. Okay, so that's what I'm looking for. So the idea would be now is, if this is going to happen over the next 18 months to 2 years, not all in a straight line, but as you can see, we will drop, we'll probably have a very strong bounce, and then we'll have a drop again. So how do we trade that? Using the options in a similar sort of manner to what we did with the gold trade. And because we're expecting this one to last us longer, we'll want to have enough time so we don't get caught with the time, because this is the big one that we are looking to actually anticipate. So going back to the going back to the option trade on here, you might like to take a note of this particular website. It's etfdb.com. okay, etfdb.com, and there you will see all the ETF related to Japanese equity. And likewise, in fact, this has crashed, so you don't see it, and I don't want to waste time, but you'll see all the ETF. It's a whole database of all the different ETF. Now you can do options on futures contract, but I think that might be a little bit too big, and perhaps too much for many beginners, because we're looking to keep a position relatively small and understand that the risk is manageable, but still reap the benefit of long-term move in the market. So we will be using ETF wherever we are talking about futures market, like indexes or S&P 500 or anything like that. And where we are talking about individual stocks, then of course we'll go for individual stocks. But if we were talking about commodities like coffee or cocoa or orange or sugar, platinum or silver or anything like that, then it's best to look for an ETF, because we can then actually decide exactly how much position we want to have, and we are not stuck with necessarily having an options position on the full futures contract. Okay, so we'll be looking at ETF. So on this particular site, you'll see all the different ETF. So this particular page you see now is ETF for all Japanese equities. And what I was looking for is, you can see the total asset. So these other ones here are relatively small. I mean, big for us, because we are not actually going to be putting in something like, this one is 2,762. And I think this is multiplied by 1,000, so it'll be like almost like 2 million. But you can see as the position here, these two are the two largest. So one would imagine that if they were the largest fund, they will probably be more liquid compared with the others. And because we wouldn't want to spend a lot of money on a illiquid fund buying options, so we want to try and actually prefer one which is very large and is likely to be very liquid. Okay, they won't be as liquid as something like ETF on a spider, or like I say spider, like S&P 500 or Dow Jones, for example, which is a ETF called Diamond. So they won't be as liquid as that, but they are, from this market, they are the liquid fund. They're the largest fund. So we're going to be using the two. Out of these two, I'm going to be looking at this one here, iShare MSCI Japan Index Fund. That's the one I'm going to be looking at, symbol EWJ. Okay, so when we look at our options, and by the way, this ETF should reflect the Japanese market, but it's not exactly the Nikkei Index that we looked at. Okay, so there is a proviso, and in terms of the chart, there is a slight difference. So this is the Nikkei Index chart, and then the other two charts that I considered, this one here is the ETF for the Nikkei Index, and this one is the hedge fund. Now this hedge fund, I'm not fully sure, and you might need to do a bit more homework on it, but it says hedge fund, so I'm not sure why the hedge fund. Okay, so but when I look at the chart, it seemed to suggest to me very similar to this other chart, and that is very similar to the actual Nikkei Index chart itself, which is this one here. Okay, so we're making this top, the actual amplitude of some of the swings in proportion to the rest look different, but nevertheless it is still reflecting the Nikkei Index or Japanese market. So out of the two, I won't be looking at the one where it says hedge fund. Okay, so this one here is sorry, this one here or that one here, this one here, it says hedge fund, so I won't be looking at that hedge fund, so I will close that off for the time being. Okay, but I think it is still just the same as the normal index. But the reason why I say hedge fund, I might need to do a bit more homework on it, but the price looks very similar, so I can actually use this as well. But nevertheless, if I close that, then we go back to this chart. This is the chart we are looking at. So you can see where the highest high on the chart is actually posted back in May 2013, over a year ago. And then we've had this rise here, drop and back rise, like almost like a triple top. Whereas in the Nikkei Index itself, we don't have triple top. We have, you can see, this was the day when the other one topped, this back in May. But then we had this congestion, then another leg up. So another leg up on the index was actually higher than this spike here. Whereas on this chart, we see that spike was actually higher than any price subsequently. So anyway, suffice to say that I think the Nikkei Index has topped. And go back and view that video, which will explain to you in great detail why I think it has topped in January. Okay, so now if that's the case, we are expecting this price to drop back to the lower end. That's what we are expecting based on our Nikkei Index chart here. Is we're expecting it to come back and at least retest that low, or maybe drop, make a new lower low. So if that happened, then on this chart we'd be expecting this price to drop down or retest that, or make new lower low. But the reading you can see is a little bit different. Okay, so this one here is saying it's 1775. So 1770. So okay, keep that in my 1775, and maybe I've got a bit muddled up. This one here is the one that I was looking at. It has a slightly different reading there, but I will see on a NKY if there is an actual option, then we'll consider that. Otherwise, this is the one that we're going to be using. So on the top is the Nikkei Index, and on the Nikkei Index, as you see from the other chart, we're expecting price from here to drop something like that. Okay, something in that manner. So when this one drops down, one could imagine the price coming down to this area, which would be like 61.8% retracement, and also previous structure resistance could potentially act as a support. So in that case, what we might have is the price come up to there and possibly bounce from that, something like that, and then maybe the second leg would come down and take us to the destination we're looking for. So we're not sure how it will actually develop, but we are expecting the price to drop. So that would be the first target, that zone. So if it gets to here on the Nikkei Index itself, we think from the current level, which is around 15,539, so we're expecting that to drop to somewhere about 11,000 or maybe 10,000. So we could say that if it dropped by 50%, it would take us to at least like 12,000, right? So it would at least bring us to this area here. So say 12,000. So that's a 50% drop. So on the ETF, if we had a 50% drop, then we'll be coming to somewhere in this area here, which is about 9.67. So we'll round it up and we'll call it 10. Okay. So we think that even this index falls down to this level here, around about 12,000, we could find that this ETF could drop to about 10. So with that understanding, let's go and have a look at the option. Okay, so in these options here, we are looking for, let me just check if there was a Nikkei Index NKY, see if there's an option on that one. Yeah, there is. It's going to come up with something. Yeah. So this one's got March 2015. Okay, so it's not long enough. March 2015 is the longest, but because I'm looking for a trade that will last me a longer period, 6 months might be fine, but it might be a little bit too short. Okay, so I think I'm going to ignore this for the time being. I'm going to be taking a trade on that EJW. Okay, so here we have a trade for 2015 as well as 2016, right? So January 2016 would be long enough, really long enough. I think it might not be long enough in a sense that we won't reach the bottom we were looking for, but at least for reaching 50% retracement, I think that is more than adequate. This would be fine, but just in case. Okay, so it may be fine, but maybe it's best to have this one and get out early. Okay, so with that, I'm going to close this one, which says September, because we're not interested in the September. Okay, we don't want September, but what we do want is we want January trade, and we also want January 2016 trade. I'll explain to you in a second why. Okay, so within this one here, we said we could drop down to 10. So that's a 10 here. So this side is the put options, this side is the call options. Okay, so if this is the put options, we want to buy a put, and currently you can see, looking at 2016, 10 is costing us 28.36. Okay, so bid is 28 and ask is 36. So we can probably try and get something in between. So if you did this one, just look at one particular contract, then we'll be looking for 100 shares. So 100 shares, that would only cost you like $280. Okay, $280. Sorry, $28. So let me just check here, make sure the calculation is right. So we're looking for 100 times 0.28, say. Yeah, $28. So you might, you might say that's really not, it's too small, $28. So we might actually do larger position. We might do, say, for example, 10 lot. So that will give you a total cost of 280. So that would be one possible trade where you look at straightforward put option at somewhere about 28, or maybe somewhere in the region of 30, 32. So that's one trade. Okay, so on the chart, what we want to do is we want to now try and put some positions on. So this one is ETF. This one here, not that one. EWJ. Probably close the wrong tab, I think. DXJ, no, EWJ. EWJ. Let me just load up another chart. Maybe I should close some of these other tabs that I don't need now. Okay, so here we want EWJ. And it's stock EWJ, is that one there? Okay. Go down to weekly chart. Okay, so on here we are looking to put down, not put down, but we're looking to take a position for 10, this one here at 10. Okay, so that's 10. We're looking to take a position there, here, but the price is there, so it's costing us to take a put option here. It's costing us somewhere in the region of about 32 cents, 30 cents, something like that. So it's cost this one here. So we say January 2016 put 10. Okay, so we're looking for times 10 contract, and that would cost us approximately $280 to $300. The market is closed now, so really any price that we are looking at is only a like an indicative, but we can work the final figures out once we've decided what we are doing. Okay, so this is what we're going to be buy 10 January 2016 put for 10 put, okay, at a strike price of 10. So it's going to cost us $280 to $300. And if we did this, what could this one achieve for us? So theoretical calculation only. So if we, for example, wanted to go and say take this one, the January 2015, this one here, and say we're looking to buy this one, and what we will do is we'll put our initial price level in there. So we're buying 10, and instead of buying that at this price, we try and get it for about 32, say. Okay, so if we, for example, just put in there 32 at $32, and we want to now try and see how that might look when the price gets to the level we are looking for, right? So we'll be buying it for about approximately 32. So if you buy 10 contract, that means we'll be spending $320, right? That's 10 contract, that's like 1,000 shares. So $320, and this curve is the one that we want to see. We don't want to really look for this risk graph you see here is based on expiry. As you can see in the box, it says expiry, and we won't be holding this one to expiry. We will be getting out somewhere in between, well before the expiry date. Okay, so we'll start going off here. This is where the price is now. So supposing price drops to around about 11, if it gets to 11, approximately there. So what we are spending 32 cents will be worth, in the box you see theoretical value, it will be worth somewhere around $55 to $60, 55 cents to 60 cents. Okay, if this price continues to drop and it gets to the level where we are talking about around about 10, then we're expecting that price to get to somewhere in the region of $1, 95 cents, 90 cents, something like that, maybe $1. If it gets any lower, something like instead of 10, say it gets to about 9.50, then you can see the price we are paying 32 cents will be worth $1.15 or $1.20. So literally 4 to 5 times as much. That's what we're expecting, and that would be, does it really doesn't matter. But I mean, supposing it took about 6 months or it took 9 months to do that, not impossible, because when the market begins to fall, it's not that difficult for this price. You can see over here it shot up. See how fast it shot up. So for example, that was in February 2013, and by the time it got there, it was May. That took us February 2013. So almost like 10 months, 12 months, 13 months. So it took a year, say. So okay, so supposing it takes a year from there to get here, so in 1 year or a little bit longer, you'll be looking to multiply that about 4 to 5 times. That's good risk to reward ratio, as well as it's annualized. It's a good return if we get it. Okay, and we have plenty of time for it to work. And we know, for example, this trade we are considering, because we know we have reached the likely top where the particular ETF topped back in May 2013, but the Nikkei Index itself only topped in January 2014. So with that understanding, that would be one trade we could look at. Okay, so that could be one option. This could be option 1. That's one possibility. Now here we have spent a lot of time from May up till now, over 12 months. So what if we find another 2-3 months go by? What if we find that this price goes up a little bit more before it comes down? Going back to the risk graph on here, if the price, say, from where it is now at approximately 11.96, so supposing if that price goes to, say, 12.50, right? So if it gets at 12.50, for example, somewhere around here, somewhere around there, so we could find that what we are trying to buy this one for, no guarantee we will get it, but we are trying to buy it for 32 cents. So you'll be losing from that. You can see we'll be losing nearly 30% of that value. But that 30% of the value is only out of the money that we put out. So if the price go against us, it's not going to be advantages or disadvantages to us in terms of a drawdown against our main account. Your cash balance would still be whatever it is once you completed the purchase, but it means that we would have to be willing, if the price went up there, we have to be willing to maybe understand that it would be adverse excursion, but then the price will start coming back in the favor that we're looking for when it will start coming back up. So it means that we might have gone in a little bit too early. However, I think in terms of timing wise, I don't think we are going in too early, because let's say the index only topped here, but this particular ETF topped back in May last year. And if you look at this other chart that you have seen me show you, this one is where on the top is the Nikkei Index and at the bottom is the Dow Jones Index. And in the previous video I've explained the correlation between these two charts, and where we are now with Dow Jones, where the Nikkei Index has already topped, I think, and the Dow Jones is now very, very close to topping, and therefore there is a good chance that the whole entire market would come down. So there's a lot of reasons why I think it's unlikely for this market to suddenly shoot up another 20% compared with a drop of 20%. So the risk of drop now is much more higher than the risk of the market going up another 20% from where it is now. Okay, at least over the next 6 months to 12 months. So because of that, we can plan this particular trade we were just talking about. This one here. So that's option one particular trade. The other trade is that if this one we think will say get to 1250, maybe it could even, if need be, once it breaks it could go even higher. But say for example, if for now, instead of finding that was the top, for now, supposing this happens in the next, supposing from here we get a leg up and then it comes down, we don't know that yet, okay, but suppose it did that. So what we could do is we could, for example, try and collect some money for any adverse excursion to help us subsidize this one, okay, or reduce our risk. But certainly if we can, instead of spending $280 to $300 or $30 or $320, supposing if we try and collect some money from there, if this market went up, and even if it didn't, and if it came down, suppose we try and reduce the cost. So the next trade that or combination that I'm suggesting now to reduce the risk and therefore give us a better risk reward, even better than what we are talking about. We said already we could be making 4 times or 5 times our initial money, but we want to try and improve that even more so, and we could then be really relaxed because our risk would be a lot less than that. Okay, so say if I put this one at 1250, and we'll make that one a different color. So at this level what we're going to do is we're expecting price to go up, and we said 1250, but it doesn't really matter because the price can go even higher, even it can go even up to 30, it doesn't matter. So what we're going to be doing on this one is that we could go back to this quote here, and we could say sell to somebody 1250. It doesn't have a 1250, so we go to sell to somebody 13. What we'll do is we'll sell to somebody, because 13 might not give us a lot of money. 13 is a lot less than that. So what we'll do, we'll change that slightly. So this one, instead of 1250, we'll make it 12, because on the other one that's where the strike is. Okay, that's where it is. So that's almost where the price is now, right? So what we're going to do is to try and collect some money from somebody to help us subsidize our main position. So here what we're going to do now is we're going to sell to somebody this 12 here, also for January 2016. We're going to sell this one, and to make sure that if the price go up, we are not going to be suffering too much, is we're going to buy exactly the same price, but we're going to buy like January 15, or maybe because we only want this one for next few months, another 2-3 months maybe at the most. So maybe what we could do is, okay, we'll stick to January 2015 is good enough, and we are looking for 12. Is it going to give us 12? Yeah, so it's 12 here. So we are going to buy this one, which means we have a protection up till January 2015 at the same price that we are selling somebody 2016, and in order to buy that for us, it's costing us somewhere in the region of 40 cents, and we're going to sell somebody almost like 90 cents. So we're going to be looking to collect best part of 50 cents, and if we collect 50 cents, then in essence the trade that we are putting out on this chart is almost paying us. So in other words, we are not having to actually pay very much, but we are financing our position from this, and we want this to resolve by January 2015. By January 2015, we want price to be well below where it is now. Okay, we want this price to be at least somewhere around here, minimum, because then we can be sure that the price is not going to go up. If it begins to go up, then we'll have to review and see what else needs to be done. But otherwise, we are looking to sell somebody. So let me put this one down now. We're still going to be doing this trade, but to subsidize that, what we're going to do is option 2 is we are going to we're going to do that. Next one, we're going to do B. We're going to say buy 10 of January 2015 call with a strike price at 12. Strike price at 12, and that's costing us approximately 40 cents somewhere. Okay, 40 cents. So it's $0.40, and then against that we are going to sell sell 10 of January 2016 call with the same strike of 12, and for that we may be getting somewhere in the region of what, 90 cents, 90, somewhere around 90 cents. So the difference is about 50 cents. So that 50 cents is easily going to cover us for this one here. So effectively, it doesn't mean that there's no risk. There is a risk in here. However, we are practically using somebody else's money to get us that particular trade. Okay, so let me explain now. Okay, sorry, let me just do that again. So we're going to be doing option number 2. We're going to be doing this. Then the B is going to be buy 10 January 2015 call 12 call for approximately 40 cents, and we are also going to then sell somebody sell to somebody 10 contracts of January 2016 coal, 12 coal, and that's going to cost us, or rather give us approximately 90 cents. So if we would want to try and see if we can put this entire trade as one trade. Okay, so that's a trade number 2. Okay, that's better. So it's saved now. So that's the option number 2. So if you go back into our quote program here and we try and put that as one trade, see what it comes out at. So we're going to be doing okay, so we're going to create a spread. So here we are going to be buying 10 contracts, January 2016. Strike price we're going to do is 10. And it's going to be put. Okay, so we're going to do that one. Then we are also going to now add a call option. Again 10. We're going to be doing January 2015, and we're going to be doing it at 12. We're going to buy at 12, and then we're going to add another call, and this time we're going to sell that call. But the sell call we are going to do is for January 2016, and again at 12. So the entire trade, they're saying somewhere in the region of, we could get like 17.5 cents to 30 cents. Okay, so yeah, so for the bid is that they're asking for 30 cents. So if they're going to ask for 30 cents, we want to try, sorry, this is the negative. We have to look at this as the negative. So we are going to get 17.5 cents or 30 cents. So we want to obviously try and collect for 30 cents if we can, right? So here, if this price went back up this way, we were saying it can go up to about 13. So if it went to 13, you can see if you look at the one in this copper color, not the green, not the expiry, we look at current price, we're not going to be losing a great deal. Okay, even if it gets to 13, it just means that we'll be losing some time. If it begins to get our way, and say for example it gets to somewhere in the region of 10 that we were talking about, right? So it's going to be then 71 cents. So it would be immensely beneficial. And the idea is that the what we are collecting almost like 50 cents. So that 50 cents means that if the price drops far enough, then both the one that we are buying at 40 and one that we are selling at 90, they'll probably both go to zero or very close to zero, and that's what we want. So we mean that as it begins to come down, we will be looking to buy this one back that one we sold for 2016 because it's too far really. We're only doing that to try and get some premium. So once our January 2015 call begins to run out of time, by that time we should be, as I say down here, we'll be looking to see what to do with that one. Maybe we will then close that one out completely, in which case we won't get entire 50p different, 50 cents different between them. We might finish up getting maybe 30 or 40 cents, but that's fine because it's basically helping us to pay for that, and whilst also subsidizing our costs, so that even if it went up against us, it wouldn't really hurt us very much. Okay, so that's what we're looking for. So if you come down to this area here, then practically putting no money down, we'll be able to collect about 70 cents to 80 cents, maybe even like $1 as the price drops, because it depends how quick. If it begins to drop like this one, we could be looking for price appreciating fairly quickly. So theoretically we'll be looking to completely come out of that position somewhere around $1, just under $1. Okay, so let's we could put this position on. So we could now go in and say create an order. Right, so he's saying this spread is going to be net credit to your account. That means, remember we were saying we are actually getting more than what we are paying for, right? So you could do that, or you could even say I will increase my put options, but let's not get too carried away. Just keep it simple like that, like the one I just showed you. So we'll be getting net credit to our account. So we want to try 18 cents or 30 cents. So we'll try and go as close as possible to 30 cents. So say for example instead of 18, we'll put it down, say, and because we have time, we can probably try and put, we're buying 10 contracts. So instead of doing all 10 at one price, we can probably do 3 or a 4 or a 5 contract at one price, another 5 at different price. So maybe 2 or 3 different positions. But for our exercise, we'll just assume we'll get, say, 28 cents, right? So that's what we're going to get, 28 cents. Okay, so he's asking us to confirm that particular. We'll be looking to get 28 cents in our pocket. Okay, so that'll be paid into our account, and we don't really we have some risk on it, of course, very little. At least up till January we are protected, so we don't have a lot of risk. We have small risk, but then by that time, if the position begins to work in our favor, then we'll be happy because we'll be far away. We'll be happy for both of these actually to go to zero. That's the best position, to go to zero, because we have no more risk to the upside and we still own the put option because the price is coming down. Okay, so we could finish up with that 28 cents paid in the pocket now, plus we if this one gets down to here, we'll be looking for that getting into a $1 position almost. So you can imagine that our 10 contracts, which is 1,000 times $1, that's like $1,000. Okay, so if you got baskets of different trades on different positions, each of them may be looking to collect $700-800, $1,000, maybe more. It could soon begin to build a very small account, very very modest account, into some sizable figure in due course. So that's a trade that we've just positioned there, and we're going to be spending on here. We'll be looking for a total cost for all of this year, total cost of credit of 28 credit times 1,000 equals $280 we'll be getting in our account. So we will now follow this trade in some time to come, but these are the kind of trades we could be looking for these big kind of positions, and likewise we'll probably be able to plan for you can do this on anything. You can do this on currencies, on individual stocks, commodities, and the thing about them is that you won't be entering in all of this position all in the same time. So it's limiting major systematical error if we all get into a position at the same time where our timing is wrong. So we've mistimed it and we are really badly wrong. So it would avoid that. Secondly, when we enter in some trades will be progressing quite well, others will be new, some will be in time coming to maturity. So there'll be trades at different cycles. So again, you won't have risk of entering everything at one position one time and then finding things going wrong because timing was wrong and taking a risk. So if you get some wrong, they will be all at different maturities, different time of development. So the risk would be spread, and they will be as much as possible market with less correlation. That means if some is moving in one direction, others might not necessarily be moving in that same direction or completely the opposite direction at the same rate. So we'll try and have mixture of that. So and we could finish up with maybe say 10, 7, 8, 10 different trades running, spread across some new, some midterm matured, some coming to the end of the maturity, etc. But approximately about 10 trades. And in doing this, if you had a total account of say even $5,000, although I think it's a little bit too small, but say to keep it simple, we'll make it say $10,000. So out of the $10,000, we would generally plan not to spend anything more than about 40 to 50% of that committed at any one time. At any one time, we would not commit more than 50%. We will try and restrict ourselves to using only 40 to 50%, because it means that if you take some loss, then it's your overall position wise, you still got a good bit of cash money available, so that even after taking a loss on some trade, you might still be able to consider other potential trades developing. But we would, broadly speaking, try and remain around about 40%, below 40% ideally, but 40% to maximum 50% of our trading capital. We'd not go beyond that trading capital, over leveraging ourselves more than 50%. But we could increase our position size by doing the kind of trades I just outlined here, where we're actually using somebody else to pay us to do the trade. Not necessarily take a risk away from us, because the risk still remains with us. And on this particular trade, the risk is that we may have to close our position completely, where the market has gone higher and we are coming toward the end of our call option, which is January 2015, which is our protection option. So if we're coming toward the end of that, then we don't want to remain in the market if the market is still climbing up. So we may have to close it, and then we may have to give this $280 we collected and maybe a bit more, right? So there is a risk involved. But before we get too far away, we would see what the market is doing and whether there is a need to be concerned. But at the moment, remember, we are protected at 12, so we could remain, and we could make an adjustment on this if need be later on. But for the time being, that's where I'm going to close this video. But I did want to outline to you how we might be able to start planning for this trade. And I put a trade in there for collecting 28 cents per each, or $280 for 10 contracts. But we might find that we might not get all filled at that, so we'll have to tinker with that figure. So we may even say, for example, split that into 3. Maybe we say we collect or try and put a position with 4 contracts on that level. Maybe another 3 at instead of 280, we'll reduce it down to something like 250, 25 cents, 28 cents, 25 cents, and maybe one a little bit lower down, like 22 or 23 cents, with a view that at least some will be filled at a good price, and then the other we can try and see where to whether to do it at a market or whether to be a little bit generous and pay a bit more, but eventually get into a trade. So as this trade continues, we'll then be able to do further adjustments whereby we start reducing risk or start increasing our potential profit. So go over this video a few times, view the previous one which talks about where you can go to learn about basics on options, but this is keeping relatively simple, and we would have plenty of time to actually plan for this trade. Even if the market begins to collapse, we shouldn't really worry us that we need to jump straight in right now. We can take time, because the price won't change too much while the price of the option won't change too much while the overall price remains in this vicinity. So that's the beauty of this kind of long trade on option, because you're not rushed. You don't have to put the trade today, otherwise tomorrow you're going to miss it. It's not like that. And equally the downside, remember this one here we got till January 2016. I mean, it's possible for the market to really not even notice this and come all the way down to this sort of level here, this bottom end, which is around about 850 and 9. It's quite possible for that to happen. So there's a lot of potential on this particular trade, but only time will tell how it pans out. So I'll close that here, and what I was also going to say is that the options group that I'm thinking to set off, which many of you already know about and have inquired and expressed your interest in it, is going to start off from 1st of September. During the month of September, we'll be looking to identify different markets and what kind of trades we might look for. So on your demo account, you can begin to experiment, and you can begin to check, counter check and double check yourself, and come out with opportunities where different trades might line up at a different time. So during the month of September, that's what we will do. We'll also cover some other essentials about money management and things, but the subscription starts from 1st of October. So that's from 1st of October is where a paid subscription starts. But those who are wanting to join at a concessionary price, which I have yet to finalize, but if it will be really value for money, I believe. But in order for individual to secure that, it means that they have to join during the month of September and pay for the month of October, right? Once you join and you paid for the month of October, then you'll become a subscribed member, and you'll be allowed access into materials that I will have to share with you, which otherwise would not be available for free. So anybody who wants to join will join me for month of October, but ideally join me in September and pay for month of October, and then monthly subscription thereafter. There will be no free subscriptions, I'm afraid, or what people might say, give me a trial, because on an idea like that I'm talking about here, it's not possible for me to give you a trial. If you want a trial, then it means you're not sure, and that's fine. That means you'll have to take some more time and join when you're ready. Go over the material that I have already provided free, and that you can glean from my profile page on TradingView with several charts that have been put up there. You can see whether there is any merit in what I'm suggesting, and whether this will assist you both in terms of learning and planning and doing demo trades, and see if this actually turns out profitable for you. So call it an educational lesson. So for that you'd have to pay, so there's no trial at all. But you can join me from 1st of October, pay for the October in month of September, and it will be at an advantageous price, which, as I say, I haven't finalized yet. But you can join me afterward, the membership, I initially plan to keep it open for new members to join until end of this year. Come 31st of December, right this moment in time, I may review, but I think I will close. So nobody will be able to join me for this service after 31st of December. It will be completely closed. If I make any changes, I will let you know, but otherwise it will be closed. So whoever joined between now and end of December, that's it. That group will close. If this group is going to be different, it's not the kind of group that you might come across frequently anywhere else. It will be quite different, and really we will be looking to trade massive swings, and in between we said 10 trades or so. That generally would be the overall makeup of our trading position. But the reason why I said we'd only commit between 40 to 50% of the capital is that there may be some shorter term trade. And shorter term trade doesn't mean day trading. It means a trade that might last us, say for example 2-3 months. It might be quite interesting trades for 2-3 months. So we would consider those too. So in between these big trades panning out, we would be looking for shorter term opportunities, but all of these would be on the basis that we don't have to sit and stare at the PC all day long trying to monitor what's happening in the market all day and be distracted by every financial bulletins, positive or negative, that might come out. We would trade using almost like end of day, and if you don't have time to check the price every day, that's fine. Some of these trades you might not even have to check once a week even. So no big thing, and monitoring them shouldn't take you much more than 10-15 minutes maximum. In the service that I provide, there will be some screenshots of charts. There will be links to a live charts as well. So if there's any changes, you'll be able to see what changes I've made, and there will be some in between recorded update bulletins during the midweek. And once a week, what I plan to do is like a business briefing, which we can hold over the weekend when maybe more people are able to attend live, but it will be recorded for anybody who wants to play this afterward or view it because they haven't been able to attend the live session. So it will be recorded. However, we plan this one to run over the weekend, where we can go over any existing trades, we can go over any adjustments we need to do, and possibly start looking at potentially things coming up in the future. There may be some individual markets you might be interested in, which I don't say I will cover every request, but we could look at that, and if there is potential interest in there and profitable trade, then we have no problem, because we will consider any markets. In this particular group, our main thing will be trading options, but individuals with some experience might be able to trade themselves using the technical analysis and the charting we'll do on here by themselves in any other market. But I can quite imagine, because we'll be doing stocks, we'll be doing indices, precious metal, commodities, foreign currencies. So you shouldn't really have like any market take you by surprise. We won't go into very small exotic markets because we are interested only in trading very liquid market. That's where we can be safe, because we know we can pay narrower spread, and likewise it will be liquid, so we can get in and get out without too much worry. Okay, we won't go into some exotics and some double and triple X kind of funds where they move double the amount that individual underlying instrument moves by, because by nature they are relatively smaller funds and the options on them are not as versatile as the ones on some of these liquid funds. So we will be covering those. So in the business briefing we could do that. We could also get involved in any elements of further teachings, both in terms of charting, how I do my charts, some element of Elliott wave for many of you who are interested in that. So we cover all of that in our business briefing, and then in the midweek there will be updated charts either by email or in the member section on my website that you saw, and shorter videos where these are necessary. Okay, so I'm excited. I hope that many of you will take the opportunity of joining this. I really wish to give a name to this particular group, and at this moment in time I haven't, but I'm going to be in the interim calling it like a private group, like you've heard of some private exclusive wealth clubs or something. So this one will be our private options group, where hopefully the concept we are looking at can be used to grow some modest account into something reasonable once you gain adequate experience and are able to use the knowledge on a live market. And until then, I'm assuming that you will use it for trying it out on a demo account, and if this gives you confidence, you might be then able to make your own decision on whether you want to transfer that across to the live account. But I'll leave that to you. I'll close the video here, and it will be uploaded as soon as I've finished finalizing the details for you all to look at. And I would welcome your comments, any suggestions. Go to my website, and there under the contact you can put in your questions or comments or suggestions. I'll look at them, and hopefully we'll look to hear from you. And thank you for your time in the meantime, and I hope you found the material interesting and educational. Bye for now.